Okay, so you want to own a rental property empire. Buy a few houses, collect the rent, let someone else pay off your mortgages, and retire early. That's the pitch. And honestly, it's not wrong. The mechanics are real. But here's the strange part. Most people who try this end up working harder than they did at their day job, for less money, while sitting on $1 million of debt they can barely service. The landlords who actually get rich aren't the ones who bought the most properties. They're the ones who figured out the math before they bought anything. By the end of this video, you'll know exactly how rental empires are built from scratch, what the money actually looks like after expenses, and why the difference between a cash-flowing portfolio and a slow-motion financial disaster often comes down to one number most people never calculate. We're going to cover what it costs to get in, how the revenue model actually works, the hidden costs that eat your returns alive, real operators who built real empires with real numbers, the one pattern that keeps wiping landlords out, and what the actual profit looks like in 2 concrete scenarios. So what does it actually cost to get into rental property? Let's start with one unit, a single-family home in a mid-tier market, say Columbus, Ohio or Kansas City, priced around $200,000. To buy it as an investment property, you're putting down 20 to 25%. That's $40,000 to $50,000 in cash, just to open the door. Then closing costs, another 2 to 5%, so call it $5,000 to $10,000. And you need a cash reserve, because the moment you close, something breaks. Assume another $5,000 minimum in the bank. So your all-in entry cost for one property, before you collect a single dollar of rent, is somewhere between $50,000 and $65,000 in cash. Now, if you want an empire, you need more than one unit. Most serious investors shoot for at least 5 to 10 doors before they start seeing real portfolio-level income. At 5 properties averaging $200,000 each, you're talking about $250,000 to $325,000 in cash deployed just to acquire them, assuming conventional financing. Some people use a strategy called the BRRRR method. Buy, rehab, rent, refinance, repeat. You buy a distressed property cheap, fix it up, pull your cash back out through a cash-out refinance once it appraises higher, then roll that cash into the next deal. It works. But it requires construction management skills, good contractor relationships, and a lender willing to do repeated cash-out refinances on investment properties. It is not passive. The alternative is commercial financing. Once you hit 5 or more units in a single building, banks shift you from residential to commercial loan terms. Interest rates go up, terms get shorter, and you often need a personal guarantee and a business entity. The point is, getting to an empire requires either a lot of capital or a lot of hustle. Usually both. Okay, so how does the money actually flow? Here's the model in one line. You collect rent, you pay the mortgage and expenses, and the difference is your cash flow. That sounds simple. The problem is the gap between rent and expenses is almost always smaller than people expect. Take that $200,000 house in Columbus. Renting at $1,600 a month is realistic for a decent 3-bedroom. That's $19,200 per year in gross rent. Now your mortgage on a $155,000 loan at 7.5%, which is a realistic rate for a 2024 investment property loan, is about $1,085 a month. That's $13,020 per year just in debt service. You have $6,180 left before a single expense. That's your gross margin. And now the math gets uncomfortable. Property taxes on a $200,000 house average around $2,400 a year, though this varies hugely by state. Insurance for a rental, not a primary, runs around $1,200 to $1,800 annually. You should budget about 1% of the property's value per year for maintenance and repairs. That's $2,000, and you need to account for vacancy. Even a great property sits empty for a few weeks between tenants. Budget 5% of annual rent, so about $960. Add those up, $2,400 in taxes, $1,500 in insurance, $2,000 in maintenance, $960 in vacancy. That's $6,860 in annual expenses on top of your mortgage. Your cash flow on a $200,000 property renting for $1,600 a month, negative $680 per year. You are paying to own this thing. Now this is where people panic, and it's also where the model gets more interesting, because that negative cash flow number is missing a few things. Your tenant is paying down your mortgage every month. Of that $1,085 payment, roughly $115 is principal in year 1. By year 10, it's closer to $250 per month, and growing. You're also getting appreciation. Columbus home values have grown at roughly 4% annually over the last decade. On a $200,000 home, that's $8,000 in paper wealth added per year. And there's depreciation, which is a tax benefit. The IRS lets you deduct the building's value over 27.5 years, which on a $200,000 property shakes out to about $5,800 per year in paper losses you can use to offset other income, subject to income limits. So the full picture isn't just cash flow. It's cash flow plus equity paydown, plus appreciation, plus tax benefits. Real estate investors call this total return, and for a leveraged asset, it stacks differently than almost anything else. The problem is, appreciation and depreciation don't pay your mortgage in a bad month. Cash is cash. So here's what smart operators actually do. They don't just run the numbers on a property they like. They run the numbers backward from the cash flow target. They decide what they need to clear per door, and then they only buy deals that hit it. The standard benchmark is the 1% rule. Monthly rent should equal at least 1% of purchase price. A $200,000 house needs $2,000 per month in rent. Very few markets hit this at full retail purchase prices, which is why experienced investors look for off-market deals, distressed properties, or markets others haven't found yet. And what are the costs nobody warns you about? The ones that actually derail people aren't the obvious ones. They're the ones that show up after you're already committed. Tenant turnover is the big one. Every time a tenant leaves, you lose 1 to 2 months of rent. You pay for cleaning, painting, maybe carpet replacement. You pay for advertising. You pay for a property manager to screen new tenants if you use one. Total turnover cost on a single unit, $2,000 to $5,000 easily. If you have a tenant who stops paying and refuses to leave, you're in eviction territory. In a fast state like Texas, that's 30 to 60 days and $500 to $1,500 in filing fees and attorney costs. In a slow state like New York or California, it can stretch to 6 months to a year. That's 6 months of carrying costs with no rent coming in. On a 3-property portfolio, one bad eviction can wipe out a full year of profit. CapEx, capital expenditures. The big ticket items that don't come up every year but will come up. A roof is $8,000 to $15,000. An HVAC system is $5,000 to $10,000. A water heater is $1,200. A full kitchen or bathroom renovation on a rental can run $10,000 to $25,000. Most new landlords budget for maintenance, but not CapEx. They're separate buckets. Maintenance is oil changes. CapEx is a new engine. You need to reserve for both. Insurance gaps are another trap. Standard landlord insurance doesn't cover floods, doesn't cover mold remediation past a small limit. A single flood or mold event can run $20,000 to $50,000 out of pocket if you're in the wrong zone without the right rider. Property management fees. If you hire a manager, plan on 8 to 12% of monthly rent. On a $1,600 rental, that's $128 to $192 gone every month before you see a dollar. Across 10 properties, that's $1,280 to $1,920 per month, or up to $23,000 per year just to not manage them yourself. An interest rate risk. Most investors who built portfolios between 2010 and 2021 did it with money at 3 to 4%. In 2023 and 2024, rates jumped to 7 and 8%. Anyone who bought at the top of the market with floating rate debt or had to refinance got their cash flow crushed. Some went negative overnight with no way to raise rents fast enough to compensate. So who's actually built this into a real business? Let's talk about a few real examples at different scales. Grant Cardone is the loudest name in the space. He started with one residential unit in Houston in the late 1980s, lost money, sold it, bought it back, and eventually figured out the model. He pivoted to multifamily, apartment complexes, instead of single-family homes. By 2023, his Cardone Capital Fund controlled over 12,000 apartment units across the Sun Belt, with a portfolio value exceeding $4 billion. His argument has always been the same: scale kills the per-door math problems. A 300-unit complex has a full-time maintenance crew and professional management. A single-family home has you calling a plumber at midnight. He raises money from outside investors via private syndications, takes a management fee off the top, and earns a share of profits when properties sell or refinance. His investors get quarterly distributions. It works at scale because the expenses per unit drop and the income per unit stays stable. Now let's look at the other end, a regular person who figured it out. Brandon Turner, the former Bigger Pockets podcast host, started buying small multifamily properties in Washington state in his mid-20s. He bought a duplex, then a 4-unit, then a 24-unit complex, all while working a regular job. By his early 30s, he had replaced his income entirely with rental cash flow. His strategy was house hacking. He lived in one unit of each property while renting the others, which let him qualify for owner-occupied financing rates instead of investment property rates. Lower rates, lower payments, better cash flow out of the gate. He also bought in markets other investors ignored, mid-sized towns with stable employment bases, lower purchase prices, and rent-to-value ratios that actually hit the 1% rule. The common thread. Neither Cardone nor Turner succeeded by buying what everyone else was buying in the most popular market. They found an edge, ran the real math, and scaled only when the unit economics worked. And then there's the failure story, because this one is important. So how do people actually lose their shirt on this? The most common failure pattern in rental property is not a bad tenant or a collapsing market. It's over-leverage combined with negative cash flow and no reserves. Here's how it plays out. An investor buys 3 or 4 properties in a hot market. The prices are high, so the cash flow is already thin or negative. They tell themselves appreciation will make up for it. They put minimum down payments on each deal to preserve cash. Then one of 3 things happens. A major repair hits, a tenant stops paying for 4 months, or interest rates rise and they need to refinance. Suddenly they're short $2,000 a month across the portfolio and their reserves are empty. They start covering mortgage payments from their personal income. Then from credit cards. Then one property goes into foreclosure, which trashes their credit and triggers personal guarantee clauses on the others. This happened to thousands of investors during the 2008 crash. It happened again to a smaller group in 2023 and 2024 when rates rose faster than anyone projected. The investors who survived both periods had one thing in common: enough cash reserves to outlast the disruption and cash-flowing deals to begin with. The simple rule: never buy a property that needs appreciation to justify the purchase. Appreciation is a bonus. Cash flow is the business. Okay, so what can you actually walk away with? Let's run 2 real scenarios with actual math. Scenario 1, the small operator. You spend 5 years building a portfolio of 5 single-family homes in a mid-tier market. Average purchase price, $200,000 each. Total portfolio value at purchase, $1 million. Cash invested, roughly $250,000 across all 5, including down payments and reserves. Average rent per property, $1,500 per month. Total gross rent, $7,500 per month, or $90,000 per year. Total mortgage payments across 5 loans at 7.5% on $155,000 each. About $5,425 per month, or $65,100 per year. Annual expenses across all 5, roughly $35,000. That covers taxes, insurance, maintenance, capex reserves, and a 5% vacancy allowance. Annual cash flow, $90,000 minus $65,100 minus $35,000. That's negative $10,100 per year. You are cash flow negative by about $840 per month. Now, at current rates in most markets, this is unfortunately realistic. This is why experienced investors either go back further in time, buy in cheaper markets, buy with more cash to reduce debt service, or use creative financing. But here's the equity picture. Every year, your tenants pay down about $7,000 in principal across the 5 loans. And if the properties appreciate at 4% annually, you add $40,000 in paper wealth per year. By year 10, at 4% annual appreciation, those 5 homes are worth roughly $1,480,000. You owe about $640,000 across the mortgages. Your equity, $840,000. You started with $250,000. That's a 3.4x return over 10 years, or roughly 13% annually, even while being cash flow negative. Tax benefits add another layer: the depreciation deductions, plus the ability to do 1031 exchanges when you sell, deferring capital gains by rolling into a bigger property, can meaningfully increase the after-tax return. The cash flow problem can also solve itself over time. Rents rise with inflation. Your mortgage payment is fixed. A property that barely breaks even today often cash flows $300 to $400 per month by year 8, as rents climb while your debt payment stays flat. Scenario 2, the serious operator. You start with one duplex using house hacking, then scale aggressively over 10 years into a 20-unit portfolio, mix of small multifamily. Average purchase price per unit in a B-class market, $120,000. Total portfolio acquisition cost, $2,400,000. Cash invested, around $600,000 over the decade, including equity recycled from earlier deals via refinancing. Average rent per unit, $1,100 per month. Total gross rent across 20 units, $22,000 per month, or $264,000 per year. At this scale, with a property manager taking 10%, your management cost is $26,400 per year. Operating expenses and reserves, budgeted conservatively at 40% of gross rent, total about $105,600 per year. Total mortgage payments across a blended portfolio at an average 6% rate. Older deals at lower rates, newer ones higher, roughly $115,000 per year. Annual cash flow, $264,000 minus $26,400 in management, minus $105,600 in operating expenses, minus $115,000 in debt service. That's $17,000 per year, or about $1,400 per month in actual cash in your pocket. That's not life-changing. But add the equity paydown across 20 units, roughly $20,000 per year in principal reduction paid by tenants, and appreciation at 4% on a $2.4 million portfolio, which is $96,000 per year. And the total wealth building number is around $133,000 annually. By year 15, assuming 4% annual appreciation, the portfolio is worth roughly $4.3 million. Remaining debt, around $1.5 million. Equity, $2.8 million. Starting equity at purchase, about $600,000 invested. That's a 4.7x return, or roughly 11% annualized, plus the $17,000 per year in cash flow throughout. This is also the point where refinancing or selling a few properties becomes an option. A 1031 exchange into a larger apartment complex can compress the per-unit management cost, boost the income per unit, and push the cash flow number much higher. Operators who reach 50 to 100 units often find the economics flip dramatically. At that scale, self-managing with a small in-house team costs less than outside management. A single maintenance tech on salary costs $50,000 to $60,000 per year and handles work across 50 units that would cost $150,000 in contractor calls. This is why Grant Cardone's model targets 300-plus unit complexes. Below 50 units, property management is an expense. Above 100, it starts to become a competitive advantage. There is one more revenue stream most small landlords completely ignore: short-term rentals on part of the portfolio. A single-family home that rents for $1,500 per month long-term might generate $2,800 to $3,500 per month on Airbnb or Vrbo in the right market. That's nearly double the gross revenue on the same asset. The trade-off is management intensity. Short-term rentals need cleaning between every guest, constant communication, dynamic pricing, and supply restocking. Most investors who do this either run it as a real operation, hiring a co-host or short-term rental manager at 20 to 25% of revenue, or they automate aggressively with smart locks, automated messaging, and professional cleaning teams on contract. Operators like Rob Abasolo, who documented his short-term rental portfolio publicly, have built 10 to 15 unit STR portfolios generating $40,000 to $60,000 per month in gross revenue. After all costs and management, the net is still often 2 to 3 times what the same units would earn as long-term rentals. The risk: local regulations. Cities from New York to Phoenix to Barcelona have moved to restrict or ban short-term rentals in residential zones. Anyone building an STR portfolio needs to follow local ordinances closely, because a regulation change can cut your gross revenue in half overnight. Let's also talk about the historical arc here, because the math on rental property looks very different depending on when you bought. From 2010 to 2019, investors who bought in growing Sunbelt cities, Phoenix, Austin, Dallas, Atlanta, Charlotte, essentially couldn't lose. Prices rose 60 to 100% in a decade while interest rates stayed near historic lows. A 2012 buyer in Phoenix who put $50,000 down on a $200,000 home might have seen the home hit $380,000 by 2022. On paper, $180,000 in appreciation on a $50,000 cash investment. That's a 360% return before cash flow or tax benefits. That era made rental property look almost unfairly easy. It attracted a huge wave of new investors who assumed the good times were permanent. Then 2022 happened. The Fed raised rates from near zero to over 5% in less than 18 months. Mortgage rates for investment properties hit 7.5%, even 8% by 2023. Monthly payments on the same loan doubled compared to 2021. Anyone who bought in 2021 at the peak of prices with high leverage and low cash flow got caught. Rents couldn't rise fast enough to cover the increased carrying costs. Operators who needed to refinance variable rate debt faced brutal new terms. Some sold at a loss. Some handed the keys back to the bank. The investors who survived were the ones who bought cash-flowing assets, kept reserves, and didn't assume rates would stay low forever. The lesson isn't that rental property stopped working. It's that it only works when you treat it as a business with conservative underwriting, not a lottery ticket on appreciation. The whole model in one sentence. You are using other people's money, your tenants, to pay off assets you own, while time and inflation do most of the work, provided you bought right to begin with. So here's the real answer. Can you build a rental property empire? Yes, absolutely, and thousands of people have. But the path looks like this. 5 to 10 years of actively managing deals, reinvesting every dollar of cash flow, surviving at least one bad tenant or bad market, and staying disciplined when everyone around you is panicking or getting greedy. The small operator with 5 houses isn't getting rich from cash flow at today's rates. They're building wealth through equity, riding appreciation, and using leverage in a way a stock portfolio can't replicate. The serious operator with 20 units is building a real business with modest cash income today and serious wealth in 10 to 15 years, especially if they keep trading up. And the people who actually retire on rental income, the ones you see on YouTube with the before and after stories, almost always built their portfolio before 2020, in markets that were cheap at the time with rates that no longer exist. That doesn't mean you can't do it now. It means you have to be smarter, more patient, and more selective than they had to be. Because the dream isn't wrong. Passive income from property is real. It just has a price tag most people don't read before they sign.